Okay, let's answer some questions. And I've been talking all day because I had a 3 hour session, so my voice is a little bit raw. So from time to time, you're going to hear some silence while I take a sip of my hot tea. I'm 19 years old, and you're somewhat of a role model to me. Well, I do find that flattering. Thank you. I'm always, sort of humbled by comments like that. Currently trying to learn as much as possible from your applied series, especially from your options course in portfolio management. And I'll start my studies in September, business admin, finance. Any advice you would give to someone in my situation? Well, the only situation that I see is a 19-year-old who is eager to learn. The advice I would give is you're on the right path, not only related to academia, career, but also the path to becoming successful at what you refer to as entrepreneurial trading. Well, I'll tell you what I'll do here. You're 19. Here's my advice. Be 19 for as long as you can. Don't be so focused on the future that you lose sight of where you happen to be right now. There are times to slow down, roll down the window, and look at the town you're passing through, as opposed to racing towards some destination down some highway. You're 19. Man, if I could go back, knowing what I know now, take some time and be 19. University, I guarantee you, will be the best years of your life. It's always been said that high school are the best years of your life. I didn't think so. I didn't think they were the best years of my life, and I'm certainly glad that they weren't. I do know some people who peaked in high school. They were the best years of their lives, and since then, that's all they've ever done was high school. That's all they ever were, was who they were in high school. You're about to start the best 4 years of anybody's life is university, where you're learning new things, you're learning what you want to learn, you're meeting new people, you're growing into the person that you're going to become. Take some time and live in the moment. Live in that moment, okay? That's my advice to you. Life will wait. There's no race for it. Life will wait, but you can't go back to that period of time. And, when I look back on my life, the most carefree days, even though, when you're in it, it seems like you're just busy to get on with the business of life and becoming successful. But these next 4 years are going to be times you look back on forever with a smile, hopefully with a smile. So take some time and just enjoy where you are and what you're going to be doing. I'm a CFA Level 3 subscriber. 6 seminar videos you created over the last month have been top notch, and they served as good revision and also helped in filling some of the gaps I had in understanding the concepts. Concerning the 3-hour mock exam sessions you mentioned in the video, what purpose would they serve? Would your time be better spent elsewhere? Well, you do have a point here. I see you already have a video for each of the essay questions, and for multiple choice questions you have detailed written answer and explanations. That's true. What you get on the sessions is not so much the content of the answer and why the answer is the answer, but the structure of the answer, because structured response is a very particular type of response. It's not an essay answer. It is a structured response, and there can only be one right answer. Not that everyone will use the same words, but everyone will get the same answer. And plus, other people ask questions. You may think that you really know something until you hear some people's questions, and you hear the answer and you think, oh, wait a minute, that's not my understanding. And it might highlight to you that what you thought you knew isn't true. As Mark Twain says, it's not the things we don't know that'll get us in trouble. It's the things we know for sure that just ain't so. Let's see. Let's imagine that we remain in the current higher for longer scenario, and that unemployment remains strong, or I think you mean employment remains strong at sub 4% levels. As smaller companies need to renew their expiring credit at higher rates, some stress should start showing up in the margins of the credit market. In this scenario, do you think the Fed would start cutting rates despite unemployment remaining low? Well, with smaller companies, that's probably not going to be public debt. Public markets probably aren't going to be stressed. And there is a belief that there are too many businesses out there that have no need to be in business anymore. And that probably the tight labor market has to do with a whole bunch of companies that may have been propped up over the last couple of years with a lot of pandemic spending, a lot of small business loans, a lot of payroll support, because that was going on in Canada as well, that if your sales drop below a certain level, you got, I think it was like 30% of your payroll paid, you got pandemic loans. So a lot of companies were held afloat that otherwise would have gone away, what are called zombie companies. So there is a reckoning coming with the free market, which is healthy, to clear out the allocation of capital to inefficient uses and to release that employment back in the labor force so that other companies can then make use of it at less than 8% wage increases per year. So there is a healthy, I think, round of firm failures that should come, that need to come, and I think that could do a lot to make the economy healthier. One question regarding options. I'm running a theoretical exercise in which I'm trying to compare delta numbers for different underlyings. Obviously, each underlying has its own implied volatility, so I wonder whether a delta 0.3 for stock A is compared to delta 0.3 for stock B. Well, yeah, because the delta is proportional to the distribution of implied volatility. So I'd say, yeah, it would be. If you had a stock with a very low implied volatility, its distribution would be very tight. A 0.3 delta would be closer to where the current price happens to be than something with a very high implied volatility. It would have a wider distribution because that's, well, implied volatility is the deviation in that distribution. So yeah, it would be comparable on an interpretation basis of delta. Sure. My specific question is: does the delta calculation already account for the underlying's IV? Yeah. Yes, it would. Two questions. Can you explain how you would go about determining whether in-the-money option has enough time value to minimize the risk of being assigned to you? So the remaining, if there's let's say a put, let's start with a put. If somebody's holding a stock that they can put to you, given the interest rate that they can get now, 5.5% on money market funds, why wait a week to put it to you if the money I can get, if the time value of the money I can get over the next 5 days exceeds the time value that's left in the option, let's say, I may as well put it to you rather than try to sell it at, if I have to cross certain spreads to sell it, I may as well just put it to you. If it's a call and the dividend, if you're short the call and the dividend is greater than the remaining time value of money, it is in the long position's interest to call the stock. Let's see. This is referring to last week's Q&A, where instead of buying the January 25 TLT call with a 95 strike, you wouldn't sell a January 25 TLT put with a 150 strike. I see what you're saying. The 150. Well, you're going out to 2025. So the put, the 150, will be priced, the value of it will be based on where the forward price is by January 2025. So it's not as if selling the 150 and looking at 95 saying, it's going to be at least $55. You have to, where are we now? We're in August. So that is 17 months, 17 of 24. And what is the, let's see, that's a year and a half. What is the 1.5 year spot rate? Probably, let's call it 5%, 4.9%, 1.049. To the 1724 times your $95 where TLT is, and that will be the whatever price that is. That would be the at the money strike. So the 150, if it were here, this would be the intrinsic value of the 150. Then you have some time value, but $95 may be here, right? So it would be yeah, you'd probably have a higher risk of it being put to you, I would think. I haven't looked at any of the premiums, so I don't know where it sits. I was talking to a fund manager the other day, and he said that mean reversion is the strongest force that moves markets, and that playing this will generally translate into outperformance. Well, mean performance of what? Price very rarely has mean reversion. Usually return has mean reversion. So let's think about this is return, and let's say this is time, and let's say 7% that you think over the long term. If we look at the price return of a market, it tends to return 7%. I'm just making that number up, right? So that in periods where the return is lower than 7%, we would expect it to rise to 7%. And when it's above 7%, we'd expect it to drop to 7%. But let's be clear. If you have 7% return, let's say you have $100 and this year it earns 7%, you've got $107. And let's say the next year is 10%, you'll have $117.70. And then you think, well, these returns will mean revert, and it goes back to 7%. That is not a short on the market. This means this goes up by 7%, right? It mean reverts to its long-term return. So just because a return is mean reverting does not mean it's a short on the market. It means it's going up. It's just not going to go up at 10%. It's going to go up at 7%. So if it has a mean reversion, if it has a long-term mean reversion, in periods where the return is less than 7%, you'd expect that the return would increase towards 7%, and when it's above 7%, you'd expect the return to decrease, meaning it's still going to go up, just at a lower rate. So if you think mean reversion is the thing, you would probably look for some other asset. When this market is above its mean reverting return level, you'd look for some other market that's below its mean reverting return level, and you'd overweight this one and underweight this one. Maybe that's how you can generate outperformance. But mean reverting levels usually, when you're referring to assets, usually refer to a return level. Mean reversion between two assets might relate to a relationship between the two assets, but relationships can break down. For instance, nat gas, NG, and oil, CL, usually for a long time had a 10 times mean reverting level, meaning that oil usually sold for 10 times of nat gas. So if we saw oil at $50 a barrel, we should expect to see nat gas at $5. That broke down a long time ago. Gold and silver usually had a 50x, meaning if we saw gold at $1,500, you'd see silver at $30, and that's broken down. So these relationships between these inter-asset relationships or intermarket relationships can break down. So saying that mean reversion is a strong force, what exactly is going to mean revert? Price does not have to mean revert. Usually we think growth rates mean revert, but they usually lend themselves to moving towards some long-term return, and maybe that's what they're referring to. But unless I know what you're saying is mean reverting, I don't know that it's as easy as saying buy and sell, as opposed to overweight and underweight. Two questions. 100% options portfolio. And I was wondering on the portfolio risk tab, What risk metric would be most suitable to use? Delta dollars, beta delta dollars. Well, you have options, so delta is going to be important. So you're going to watch your delta dollars, but you have options on all sorts of different stocks. So beta delta dollar is the one to watch. And I really just keep the eye on the premium. When the premium gets to the point where I say, okay, that's the biggest loss I'm willing to take on any premium, I'll look over at my beta delta dollars and I'll think I can either close my position or I can move my position towards zero. And the beta delta dollar just tells me how much work I have to do to move it towards zero. If I think that I can exit with an option strategy that would get me a better exit than I could by just taking the loss. My main goal is to try to always have a close to neutral delta position. Well, you have to define neutral as well. So neutral can't always be zero, because that's just simply a lot of work. So if you think about one side of your option, let's say you sold a put on a stock and you looked at your beta delta dollar amount by selling the put, and it said that you'd have positive delta at that point, and it said you have 4,500. You can sell a call now and you can start to move that towards zero. The combination of the put and call should give you something close to zero. That's being neutral, but the stock is going to move, and as it moves, it's going to push up this number while pushing down this number, so you will drift from zero. So rather than saying, well, zero is my mark, you'd have some kind of range, maybe negative 1,000 and positive 1,000, under which you would say that is neutral, as opposed to just looking at this zero mark, because that's a lot of rebalancing. That you have some range under which you would say, well, in that range I consider myself neutral. I've seen in some of your previous videos you recommended theta as a percentage of your net liquidation value should be 0.001 for beginners. Currently my theta is $21 on my portfolio, but with that sum, there are call options that I have that decrease the total theta amount. That is, it has a negative value when calculating my theta divided by net. I should take out the call options to reduce theta amount or leave them in. Well, you can do a number of things. You can take the highest risk option. So let's say that you sold a put and you sold a call, and they both have theta. One of them is free, right? Because a stock cannot both go up and down at the same time. So if you want to manage your gamma risk, you want to keep your gamma risk low. You want to make theta with very low gamma risk. Once gamma risk starts increasing, that's when you want to step in and do something. Whichever direction the stock is moving in, if it's moving down, the gamma risk on your put will start to increase. If it's moving up, the gamma risk on your call will start to increase. So what you can do is just pick one. Look at your put, look at your call, take the highest delta one, because the one with the highest delta would have the highest gamma risk, and just use the theta on that. And be aware of where your gamma risk is, because when you are above your limit, what you should be doing is looking down your gamma column and saying, okay, where's my highest gamma risk? Because that'll be your highest risk position. And how can you lower the gamma on that one to bring your theta back in line, unless you're comfortable increasing your theta. But you should be increasing your theta with more positions with low gamma, as opposed to concentrating it in a few positions with higher gamma. So just pick one of them and let that one dominate, because if the put is the one that is giving you grief right now, if it has the higher delta, well, then your call can't possibly be hurting you. Your call is just something that is benign at that point that's helping you. So I would tend to ignore that one and start thinking about this. And if you have to have an understanding of the underlying as well. If the underlying is weak, if there's something going on with the underlying where it's going to be weak for a while and you don't want to take the loss, you're going to have to roll your call down to give yourself more room, more breathing time. Or what you're going to have to do is roll these both either roll this down and forward, and roll this forward. When you roll it forward, you might even be able to roll it down. the easiest thing is to just have a rule where you just simply take a loss. But it's more nuanced than that. Depending on the underlying, it may hit your rule to take a loss, but you may say, look, I'm familiar with this underlying. I know that it's going down because this other thing happened today that's an event but not a trend. And my stock that I'm holding is weak for only that reason, and that is really just an event, and that's going to go away. Then you may want to do something else to manage the position, or maybe you just want to hold it knowing that it's breached your loss limit. But that really comes from knowing the underlying. When people first come to the idea of selling options and it starts working out for them and they're making money by selling options, they think, well, what else can I sell options on? And they start selling options on a whole bunch of stuff, thinking, well, if I just follow the rules, I can sell a 15 delta option on anything. Well, no, you can't, because if it starts to move against you, you're not going to know anything about the underlying. So you're going to sort of be in the dark on that. There, you're truly just playing numbers. And if you're going to do that, you may as well just hire somebody to write a quantitative strategy for you and sell 115 delta option on 100 stocks a week and have rules where you're going to take your loss, take your gain, and let the algorithm win. Let the algorithm run, because the algorithm doesn't know anything about the underlying either. So you may as well just do that. When calculating my theta, we talked about that. What would you rather own as a non-U.S. investor? Long-term U.S. Treasuries outright, TLT, which suffers from lower coupon plus withholding tax, but benefits from liquid options. Depends on what I'm doing, I guess. As a non-U.S. investor, how am I holding this stuff? Am I holding it through a brokerage account that I can access? So am I in a country that allows me to hold those securities in a brokerage account? If I am, well, I guess, it really does depend on what my forecast is and what I'm trying to get done. So I don't know that I would have a preference just because I'm a non-U.S. investor. I am a non-U.S. investor right now, and I have both. I have T-bills, I have 25-year bonds, and I have TLT. I have a bunch of them. I prefer, if I'm a non-U.S. investor, I'm still going to have a withholding tax by holding a bond. But what I can do is I can find a long-term bond with the lowest coupon. Or if there are strips, if there are longer-term strips. If I'm not a U.S. Investor, but I'm buying treasuries, buying them at a discount, buying discount bonds or zero coupon bonds, meaning no coupon, probably makes the most sense. You can try to find strips, or what you can find bonds, longer term bonds that have the lowest coupon. So I have the 2048 treasuries, the August 2048 maturity treasuries with a 3% coupon. If I move back 2 years to 2046, there's some that drop to 2.5%. So you can try to find the lowest coupon. Your withholding will be on the coupon. If you're looking for the most tax efficient way of holding a U.S. Treasury as not being a U.S. citizen, and you cannot put it in a registered account because of a tax treaty with the U.S., and you're going to have the withholding from the U.S. government, then take the one with the lowest coupon. It will also have the highest duration. Meaning if interest rates go up, you'll lose the most on that bond, but if interest rates go down, you'll make the most on that bond. Having trouble landing a job interview. Like some advice. It's not really my thing. I'm far removed from the job market. I completed my bachelor's in actuarial science at top tier uni in the UK. I spiraled into a depressive state due to a close family member passing away early in the first year of my degree, which led me graduating with horrible grades. Enrolled in a tier 2 uni pursuing my master's in finance, set to graduate with distinction next month, passed CFA level 1 in May, writing level 2 in November. Also dedicated my Sunday mornings to your applied series content. I'm sure my grades for my bachelor's have a large part to play in this. Well, let's narrow that down. Are you getting in the room? Are you even getting in the room? If you're not even getting in the room, if you're filling out the resumes, if you're writing your cover letter, if you're writing the proper type of cover letter where you've customized yourself for the job, in other words, you showed how you're a good fit for that job, but you're not attaching any, you're saying I graduated from this university, but they don't see any of your grades, and you're still not getting in the room. It's not your grades. It's not your grades at all. It's something else. So are you getting in the room, and are they seeing your grades and then not going any further? Then yeah, you probably could say it's your grades. But if they're not seeing your grades and you're not getting in the room, it's not your grades. It's something else. Also, I'm sure my grades have a large part to play in this. I'd like to know if there are better places I can focus my efforts to land a financial analyst role. Well, I don't know enough about your situation to know much about what's going on at all. I would seem to think that probably what you could benefit greatly from is a career consultant, somebody who knows how to write a resume. It could be a problem with your resumes. You're just not presenting yourself in the best way. It could be written wrong. It could be written uninspiringly. Your cover letters could be boilerplate and template. Hey, I saw this job. I think I'm a perfect fit. Have a look at my resume. That's not enough. That's not enough. You have to show that you are that person for that job in a short amount of time as possible. It is an art, writing a cover letter. And if you're applying to 15 jobs a day, you're doing them wrong. I guarantee you're doing it wrong, because it's going to take you a good hour and a half to write, to really think about that job, to look at the company, to look up the company online. What does it do? What is it into? What are its target markets? Try to find out as much as you can about the company. And then you want to customize your letter for that, your cover letter for that. That's an hour and a half, 2 hour job to write a good cover letter, and you get burnt out after writing 2, maybe 3 a day. If you're applying to 15 jobs a day, it's your resume. It's your resume and your cover letter. Because that's just too many to apply to in any given day. So spend more time getting to know the company that you're applying to, and customize your cover letter for that. Again, I'm far removed from the job market, but you might benefit from, at your university, wherever you are, there is a recruitment center, and they will help with your resume. Thanks for the update this week. Applied Series subscriber wondering about a short position which I had on MPW. I had sold a couple $8 puts expiring August 18th, but they were not exercised this week, even when the stock dropped to nearly 7. Is this due to a lack of open interest on this specific contract? No, it just could be due to a lack of anybody that wants to put them to you. If you hold them to expiration, which is this Friday, and the price is still under $8, they will be put to you on Saturday morning. Considering I was happy to buy the shares at 8 or below, but still do not own the shares, just hold them. Again, if Friday the market closes on that underlying at under $8, even at $7.95, they will be put to you. Just want to be clear: is the price listed an annual subscription, one-time payment? It's a one-time payment for the content. At some point, the content will be done. I mean, it's not like for the next 20 years I'll be adding to it. At some point, I will be done. And then that will be it. You'll have all the content, but there'd be no recurring annual fee on that. I may introduce another product later on that you can add on that would have some kind of annual component to it. I have no idea what it could be. I don't know what it could be, but maybe there might be something I add on that's not part of the Applied series, but is a different product. But as far as the Applied series, no, it's just a one-time fee. But the price is going up this fall. I just don't know if it's November 1st or December 1st when the price is going up, but there's a lot of content coming. So it will go up to reflect that is more value. Last week you said leaps have become carry expensive. Well, whenever you have high interest rates, yeah, they will be carry expensive. Now that rates are high because options are forward price, not spot price. Can you elaborate? Well, I did on the very first when I talked about the TLT for 25. While I understand that rates are baked into the price of option, leaps are still more efficient than short-term options from a time value cost point of view. Yeah, it is. And you have carry every day you have an option anyway. So you could say, well, what does it matter? What will hurt you on that option, on that call option, if you go out a year, is if something breaks and interest rates drop really fast. The premium on your options will drift away very, very quickly because the carry will disappear. So your option will suddenly be way out of the money in terms of the call option. So as interest rates drop, that premium will disappear. I'm trying to implement beta delta weighting in my portfolio, but I'm struggling because my portfolio is very diversified across multiple classes, like for example emerging market, fixed income, European REITs, or industrial commodities. Yeah, the beta will be hard to measure because you have to pick a beta with respect to what? With respect to something, right? And the default I use is beta with respect to SPX. So it'll measure every underlying's price movement over the past 3 years with respect to the price movement in SPY, or the return series in the underlying to the return series in SPY or SPX, and come up with a beta, because that will be a beta of 1. So you would be sizing your positions based on that beta with the S&P, which might not be the best measure of risk, especially for fixed income. I struggle to find an accurate beta number for these exotic positions. What are your suggestions? Yeah, I agree with that. That is a little bit tougher. So I would sort of just have some sort of allocation where you say, well, look, fixed income, let's say it's 30%, emerging market equities, let's say it's 15%, domestic equities, maybe it's 30%, and then you just have different buckets like that. But you're going to have trouble with some underlyings. Beta to the S&P is not going to be the best measure of risk. After reviewing Q2 GDP results, I'm not sure to understand how the percentage of change of contribution to GDP is calculated. I wasn't able to find the calculation details in BEA website. Well, it's just, you say you have growth of so much. Well, growth comes from 4 broad sectors, right? The consumer, investment, government, and net export. So of the growth, how much of it was responsible for all of the categories that fall under C? I don't know that it's important to recover those numbers when those numbers are given to you in Table 2. So being that they're already given to you in Table 2, it seems to me a low payoff exercise just to do the math to get the same numbers that you already have in Table 2. Why not just take Table 2 for what it is? Unless you're trying to build a model to forecast what GDP will be, in which case I will say, why not use some of the models that already exist, like GDP Now? I don't know that you can do better than that. So I would tend to rely on research that's already been done and models that are already being built. I don't know that I would spend any time trying to build Table 2 on my own when Table 2 is given to me. I don't know that it's a good use of my time. So I would say don't worry about trying to figure out how to calculate it. It's already done for you. Let's see, on CME Treasury Analytic Tool, CME defines the cheapest to deliver as the security with the maximum implied repo. Can you explain why? So think about a futures contract on a specific bond. Let's not make it a generic bond. It is a specific bond. And the forward price on that bond is nothing but the cost of carry on that particular bond. So that if you were going to repo that bond, let's say the repo rate you would find is equal to the rate that was used to price the forward price. So that there is nothing to be gained by repoing the bond in terms of what is in the difference between the spot price and the forward price. There's nothing different in there. That the repo rate is the interest rate used to calculate it. So the repo would have to have, you can still make money by repoing it if the underlying moves in your favor. But you can't do it just with the carry. However, once you have a generic futures contract with a specific bond, the carry will have, or the spread, or the basis, I should say, which is the spot price of the cheapest to deliver minus the futures price, will have more in it than the carry. There'll be something extra in it. So what you want to do is say, well, what would the repo rate have to be such that there is nothing in the basis other than the carry? And the bond, which based on the price and based on the futures contract, of course adjusted for the conversion factor, the one in which you would have to calculate the highest repo rate for break even, in other words, at this repo rate, there is no gain to be made in the basis. That would be the cheapest to deliver bond because it accounts for the carry and everything else beyond the carry. Do you get that? So if the interest rate for that period of time is 5%, and you find a basis where the only way that basis could be that way is if we used 7%, and if the interest rate was 7%, then there'd be nothing in the basis but the carry. That's the implied repo rate at 7%. Maybe you find another one where it would have to be 8% because the price is so low. So the highest implied repo rate would be the cheapest to deliver. Questions about positions such as agency and annually. What would be the scenario or situation in the medium long term where we say it's time to sell these? That's a good question. Mismanagement? Mismanagement most likely. I'd say mismanagement. I mean, if they're doing this right and lowering leverage as interest rates go up and raising leverage as interest rates go down, and their hedging program is pretty good, and they have a hedging program in place, I don't know that I could do better. And I probably don't have access to the repo market to get the leverage that they get, so I would say I'm staying put. So mismanagement, I would think. Much better to start first with what happened during the week. Yeah, I think so. I think we're sort of switching regimes. We're seeing that money market rates week to week, there's just a big yawn or nothing to see there. Nothing to see on corporate spreads. There's some activity going on the long end of the curve, but it's usually event driven by something in the market. So your analysis, or at least how you do your analysis, does change depending on the market you're in. There are some times where watching the Fed is meaningless. It's like watching paint dry. Who cares? No one cares. 2013, 2014, 2015, 2016, who cares about the Fed? No one cared about the Fed. Every meeting, nothing changed. It's like, what's the point, right? So the structure of what I present is going to change over time, such that some things just aren't worth presenting. Given the fact that your positions in miners are based on the big push to EVs, not just to EV, right? EV requires like 4 to 5 times more copper than an internal combustion engine of the same power. Let's say it's also the EV charging network is all uses a whole bunch of electricity. Also, any renewable form of energy, any green energy, requires a whole bunch of electricity. Data centers are becoming more and more prevalent and more important in the world that we live in. Huge amounts of electricity. So there are a lot of drivers for growth in the copper market. And copper mines take 10, 15, 20 years to come online. And there just aren't enough projects in the pipeline right now to bring them all online. So there is going to have to be some kind of price increase in copper to get companies that say, we need to expand our reserves by raising our reserve price. And some of the resources become reserves. So it will have to go up, or there'll be a squeeze on copper, which will push the price up. Would you maintain the same position if government decides to reverse their big push's urgency or extend the duration of the transition timelines? Yeah, I probably might think about that, but right now it just doesn't seem to be that way. What I have been hopeful about is the U.S.'s recent investment, something like $2.5 billion or $3 billion in carbon capture projects in I think it was in Texas. That they're actually putting some money towards that, because that has some huge potential. I mean, if you can pump a barrel of oil and at the same time suck the equivalent carbon out of the air, you have neutral oil. Now, it is a finite resource. At some point, you're going to run out of oil. But why does the future have to be a single solution? Why can't it be a portfolio of solutions? Why can't you have EV where EV makes sense in the city for commuting to and from work, to the mall and back? Why can't you have hybrid for longer range runs? Why can't you have internal combustion for the heavy duty work that needs to be done where you need the power? Why can't you have hydrogen? Why can't it be a portfolio of solutions? This single-mindedness to EV to me seems rather misguided when there are many solutions. There doesn't have to be one big solution. There are many solutions. Carbon capture, if you just say, okay, well, let's replace half the cars out there with alternative forms of energy for the markets where it makes sense. And keep internal combustion, but every barrel of oil must be neutral. So you have carbon capture that's in the price of the barrel of oil, which means it's in the price of the gasoline at the pump station. You've already paid for the carbon you're about to create to be sequestered. Because EV has a much larger footprint, because of the rare earth materials that you need. Not that they're rare, there's plenty of them in the earth. It's just they're bloody difficult to extract. So it's hugely energy intensive, and that's not a green space yet. So I don't know that I would change my mind now based on my thinking that a portfolio of solutions could solve it. Politicians aren't going to see it that way. At least the politicians that are making the decisions now, unless you have a revolution in voting where the left-leaning parties are just voted out, where we can get back to some level of sanity. And yes, I'm saying sanity because we are going into an insane place. The car companies are already starting to realize that, hey, wait a minute, if we're all rushing into this room at the same time, we're all going to slit each other's throats in about 2 years when we hit a wall. There just isn't the supply available. We're going to hit a wall. We're all going to hit a wall. We can all see it. So, but it's just that 2035, governments want to shut down this, they want to shut down that, and it's like there are other alternatives. So I'm going to stick with the side of politicians not willing to take the courageous approach and suggest that there could be multiple solutions to a problem. It seems that, they repeat what they think is the fashion of the day. I want to hear your thoughts on President Biden's executive order last week regarding Chinese investment. Well, I haven't heard of it, so it must be a really secret one. What effect, if at all, will this have in the markets over the long term? Do you see this as a sign of further restriction, disinvestment? I don't know. This is a difficult one to predict what's going to happen there. I don't know. I just don't know. You can't ignore the market. I don't think that market is going away. They're number 2 as far as GDP. I don't know that the forecasts of their growth and overtaking the U.S. by 2032, 2033 are still in play. I doubt it. I think more attention is going to start focusing on India. I think that is a probably more interesting market to get to. Mexico, we know, is receiving some attention. So there are alternatives, and this is the problem with success is if you have some advantages and we start taking advantage of those advantages, eventually prices will be driven up to the point where you're not as advantageous as some other place now. Quick question about theta allocation. In your video, you calculated probability of winning. Now, this is based on large samples, on repeated trials, that if you're doing this again and again and again, you should realize some fairly stable probabilities in terms of wins and losses under normal market conditions. So wondering how taking profit at 50%, cutting losses at 100% of premium makes sense from a profit perspective, as it seems you will lose money in terms of dollar amount at the end of the day. Well, if you're taking your loss, if the ones you're taking a loss on were big premiums that you sold and the ones you're taking a gain on were small premiums. So let's say your gains were all 50-cent premiums that you sold and you're taking gains at 25 cents. But you sold $10 premiums and you're taking losses at $10. Then yeah, that's a bit of a problem. But if you're using the right deltas, the point anywhere from 0.1 to 0.2 delta, that should not be much of a problem. And if you're diversifying your implied volatility, saying no more than 20% of my implied volatility can be above 40%, 80% of my implied volatility between 20 and 40%, with no more than 50% coming from 30 to 40%. If you're diversifying your implied volatility across the volatilities, you should not get in that situation where all of your losses end up being big premiums and all of your gains end up being small premiums. They should over time average out fairly evenly. Also, if you plan to take profit at 21 days, I didn't say take profit at 21 days. How do you accurately measure your probability of winning? I didn't say 21 days. I don't know what that is. So I don't know where you came up with that. Could you provide an update on your beef and pork spread trade? Yeah, that has not been working out very well. What I did was at 70, pork at 76, 76 and a half, I closed that leg of the trade at a profit. And I sold puts, in the money puts, well, not in the money. I sold 184 puts on beef, which gave me a break even on that leg. So I have a profit on the hogs leg, and I hedged out my live beef leg. My break even is 184 and change, and now I'm just going to watch. I would have added to it, actually. I would have added it to it. But I am leaving the country, and part of the process is I have to, unwind whatever positions I happen to be in, especially these kind of positions, because at the end of the year there's deemed disposition anyway. So I want to move my money from one manager to another manager. I am moving to JP Morgan, in case you're wondering where my money's going. It is going to JP Morgan. It's easier to hand over a portfolio of US dollars or US T-bills and treasury bonds. So as positions expire, I'm not rolling over new ones. I'm just putting it into T-bills and treasury bonds and US dollars, converting everything to US. So that just made sense at that point. I looked at the trade. I said, well, I got to get out of this one anyways. It's not really working out as well as I thought. There's good premium in the puts, so let me take the premium on the puts and close the hog's leg. Looking at retirement standard portfolio structure for younger, more aggressive investor. What is your opinion on XLP as a supplement for some or all of your bond allocation? XLP, XLU, I think make a good, they have outperformance, significant outperformance in contractions. But your best outperformance in contractions will be bonds altogether. But if you don't want bonds in your portfolio, XLU, the utilities and staples, will outperform in contractions, but they tend to underperform every other period. But they will outperform. Now, that doesn't mean they go up in price. They outperform in contractions. So if the market drops 20%, they may drop 7%, but still drop, whereas bonds would increase as interest rates came down. Utilities probably would too, because utilities are kind of bond-like, and they do have a high dividend yield. XLU, I think, is around 3.4% dividend yield. With a somewhat similar yield to AGG and the potential for price appreciation, why not utilize this strategy? Well, bonds have the potential for price appreciation. As interest rates drop, bonds appreciate in price. So they do have potential for price appreciation, not just equities. Bonds also have capital gain components. You have mentioned in previous videos that you outsource more than 50% of your portfolio to managers. Would you mind sharing some of their firm names and the high-level strategies they use? I don't really get to see much of the strategies. I have, I think, three hedge funds, two private real estate in the alternative space. I have equities and bonds, Canadian bonds, and I think international bonds. I'm not really sure. But that money is being moved to JP Morgan. So I don't know what the high-level strategies they use would be. That's not really shared with me. Would you say measures of leverage can be used to forecast the financial performance of a company? Well, I don't know if a measure of leverage is what I need to forecast the company, or if I would use the measures of leverage to forecast what would happen under different scenarios, right? So it's not that you tell me what the leverage of a company is and I'll forecast its performance. It's give me the level, tell me what's going to happen in the economy, tell me what kind of leverage the company has, and then I can tell you, give you some idea of the direction if it's well managed. So companies with high operational leverage means they have very high fixed costs, low variable costs. So if any volume comes into that business, they tend to do very well because their output and their revenues increase, but the vast majority of their cost structure stays the same. So you tell me what's going on, and I'll tell you what kind of leverage is good. One of your 2018 videos covering measures of leverage used the degree of operating leverage. Well, there's operating leverage, financial leverage, and the two of them together give total leverage to show how they work, since they do explain a change in earnings. Well, it's the same as, just think about it. You buy a townhouse, I buy a townhouse. You use 90% debt. I use 50% debt. And our townhouses rent for the same thing, and we have the same expenses, except we have different interest costs. You'll pay more in interest expense than I will. However, while you make less net income, your income as a proportion of the equity that you have in will be much higher than mine. Your return on equity will be way higher than my return on equity. So it may help you forecast movements in return on equity, but I don't know that this is a big surprise on that sense. Leverage is nice on the way up and deadly on the way down. Nothing just has benefits. Everything that has a benefit has a disadvantage. Forex and currencies are outside my circle of confidence. Is there something simple I can invest in long term that will have a strong correlation with the US dollar? I guess it depends on what country are you in. So often the dollar surges and it hurts my portfolio, which has me looking for an investment that could offset that. The dollar gets stronger, so it hurts you. Well, then that means you must be in the U.S. holding non-U.S. assets for the dollar to hurt you, because if you were in a different country holding U.S. assets, that should be a benefit to you if the dollar strengthens, if the U.S. dollar strengthens. So you're in the U.S. The U.S. is your base currency, and you're holding assets of other countries in there. I think there are some companies that what you can look for are international companies that use the U.S. dollar as their functional currency, but that operate in different countries. So if you have a company like that, let's say their output is priced primarily in U.S. dollars. So miners are a good example. Output is priced primarily in U.S. dollars. Revenues are in U.S. dollars, but their expenses are in their local currencies of the different countries they're in. Usually a strengthening U.S. dollar benefits those companies. So find international companies that use that whose functional currency is the U.S. dollar. What are your thoughts on Buffett buying home builders? Yeah, I agree. Do you think that's more likely a hold forever strategy? You're just playing the cycle of home builders taking advantage of low existing inventory. Well, you have low existing inventory, which is a condition for home builders to outperform because they're not getting competition from existing homes, which is the bigger market. So it just makes them that much more attractive. The I guess question would be how long will they have that lack of competition? Still confused on how much to allocate to selling put part of our portfolio. I have 1 million. What would be the maximum amount to allocate to selling puts? Whatever you feel comfortable with. I used 50,000. If you've never done it before, use a small amount, say 30,000, and you're going to target a theta of 0.001. You may not like it. You may say, you know what, this is not for me. And then it's done. It's over with. Or you may like it and say, okay, well, let me go to 40,000. Let me go to 50,000. Let me go from 0.001 to 0.0012, 0.15. And you slowly build up that allocation. I don't know that there's an optimal number to use. It's what you feel comfortable with. And I know you picked 50,000 randomly, but it could have been 200. Could have, yeah. I want to see the potential maximum. The maximum is related to this number here, the 0.001, not the number you pick. It's not a matter of 200,000 you'll be more successful than 50,000. Success means, not how much you're making, but what your percentage of wins are. And not getting into trouble is more about the theta that you're targeting per day than about the amount of money that you're using. Could the advocates for bear flattener have this perspective? Interest rate action typically happens on the short end of the curve, and so going forward they're pricing in a rate cut, causing short rates to decline. Well, no. The narrative in the market last week was we are in a bear flattener. Bear, yes, but week over week there was no flattening. So it's not saying the market is positioning for a bear flattening. It's that a bear flattening is going on right now as we speak, and that just isn't so. I want to look at the number of bankruptcies in U.S., but I could not find it. Is it not traded publicly available? You could look at FRED, the Federal Reserve Economic Database. You could look at FRED. It tracks that, or some series for that. I think a lot of solid conclusions can be drawn. Maybe. Can you explain why an increase in the spread between U.S. 10-year and 30-year fixed-rate mortgage is negative for mortgage REITs? Mortgage REITs usually hedge out interest rate risk and lever up the spread between the 10-year and the mortgage-backed security. And the spread between the MBS would be proportional to the spread between the 10-year and the 30-year fixed-rate mortgage. So because they lever it up, if the spread is widening, that means the valuation of the security they're holding is dropping. And because they use leverage, well, that's negative for mortgage REITs. I need a little insight into how deflation in goods from China impacts the U.S. economy. Well, you're importing, whoever is importing them at a cheaper price. And if competition is alive, in other words, if it's not just a monopoly, that's simply just going to grab the extra margin. But if you have competition from other importers and you have to sell your product in competition with other people selling their product, it should drive prices down if your input costs are dropping. That's if competition doesn't have something, the competitive nature of the economy doesn't have something that's stopping healthy competition from occurring. Can you explain how to get an inflation expectation by taking the nominal yield less the TIPS yield at the same maturity? Well, TIPS is a real yield. Nominal is a real yield plus an inflation expectation. So if you have a real yield plus inflation expectation versus a real yield, the only difference between them is the inflation expectation. Just subtract them. I think a good strategy for USD, if we can project the biggest word in the English language, if gets so many people into trouble because it seems like such a small word, such a small step. If we can project the estimated 300 basis points of rate hikes still to be of effect, if we can project when the Fed will start cutting rates because the economy won't be able to sustain that based on real rates, inflation would be at target. Well, there's an assumption inflation would be at target. Be careful how you say things. You're saying a sentence as if it were a concluded fact that would be the case. Inflation would be at target. If something breaks, inflation would be at target. There's no guarantee it would be at target. You don't know that. Markets would have bottomed. Well, you don't know that either, because I think the slightly recession will come. It's just a matter of when. But I think Williams spoke on rate cutting to rates. You don't know these things. I mean, if you can project, that's a big if. Right? It's just such a deadly word to use, if, because if is a conditional. I'll have a great life if, nothing matters until you hear if. It's all the, if what. And then, this just assuming away the difficult stuff. Inflation would be at target. The markets would have bottomed. So you're just assuming away all of the difficult stuff and assuming and making the assumption that if this point comes, it would be the most perfect time because everything else would already have worked out. Everything will just work out and everything's going to be great. And you're assuming away all the difficult stuff. So, I'm going to caution you on coming to conclusions that are not warranted by the premise. Can timestamps return, please? Yeah, I guess I could put them back in. The last 2 weeks, I've had time constraint. It takes about 15 minutes for me to put all those timestamps in. It doesn't sound like a lot, but I have live sessions every Saturday and Sunday now. This weekend coming up, and the next one is next Saturday. Then it stops. So it's a matter of I got to get these things up and get everything else prepared. I'm always, especially in front of an exam with all the live sessions I do, I'm always stressed for time, always out of time. Can we please have a video where you address our comments on the videos for applied series? I do that at the end of every month. I do it twice. I do one at noon and one at 9. And it is the last Sunday of every month. And it's right on the site. You log into the site, you look at live events, and there's one for the applied series, and you ask your questions. I have the black screen up, and I draw out answers on the black screen. So I do have that. That is included with the applied series. You don't have to pay for that. You can just show up. It's the last Sunday of every month, and there are 2 sessions, one at noon Eastern Time and one at 9 p.m. Eastern Time. Several questions are being asked in the comments section on Portfolio Management Series. The recent video, Part 5, especially has some computations without the screens. That was a bit difficult to understand the computations. Well, I can look at that. Don't gold and treasuries compete as safe haven assets? I don't know much about gold. Difference is, what are investors running away from? My takeaway as to why we got the equity bull run wrong is perhaps that the analysis we were laser focused on was almost entirely on monetary policy. May have underestimated the inflationary impact of loose fiscal policy. Yeah. If concerned investors are running from is precisely with the purchasing power of the Treasury, wouldn't precious metals be where investors can go instead of Treasuries? Yeah, I don't think so. I see yields go up and gold go down. So I don't know that they're complements at all. I think gold is there for situations in which we're worried about the money supply increasing and inflation increasing and interest rates just aren't increasing. Interest rates are flat, so you think, well, I need to be someplace to hedge myself if inflation does show up, because it doesn't look like interest rates, it doesn't look like cash will help me because the interest rate isn't increasing. But if the interest rate is increasing, cash will help you because cash resets every 3 months at higher investment rates if rates are rising. Wall Street Journal published an article last week, The Scary Math Behind the World's Safest Assets. The article states 3/4 of treasuries must be rolled over within 5 years. Yeah, that's not news. I think the average maturity of treasuries is, 6.5 years? The duration of the treasury is, of all their issuance, is I think 6 years, 6.5 years. That's not new. CBO forecasts this year's interest payments will be 3/4 of discretionary non-defense spending. By 2031 as large, with rates topping at 3%. Wall Street Journal cites at 4% interest rates. Interest payments will be $2 trillion, almost as much as individual income tax revenues. You have to adjust for what the Fed holds. Okay, you have to adjust for that. And I think that Wall Street Journal, above all, should have been a little bit more careful, because what they're doing is they're saying, let's imagine this. Let's say that you're borrowing money to invest in something, and you're borrowing money at a floating rate, and you're investing in something at a floating rate plus 50 basis points. And this is your borrowings. And somebody steps in and says, oh my God, this person, look what this person is doing. This is irresponsible. This is absolutely ridiculous. You know how much interest expense there'll be if there is another interest? So if rates go up another 50 basis points, this person's interest expense is going to be X. That is unsustainable. But you have this over here that is earning money plus 50 basis points. So You can't look at the liabilities without looking at the assets. And there's a lot of focus on the treasuries, on the government's liabilities, but no focus on the assets. So you have the Fed that is holding some securities. Well, the Fed returns that money to the Treasury. All the interest payments at the end of the year, the Fed returns it to the Treasury. The Fed gives the Treasury, I think, almost $20 billion a year. Hasn't for the last little while because it's been in a negative position, but you have to eliminate interdepartmental debt. So reduce the deficit, reduce the debt by what the Fed is holding on its books. Just reduce it. The Federal Home Loan Bank, some debt was issued for the Federal Home Loan Bank. So there was a debt issuance, and that's sitting right there. But the Federal Home Loan Bank then lends that money out and gets interest plus. This is interest. So there is this, if you say, well, this money is lent to these people, this is not really debt of the government, it's these people over here, you can eliminate this intra-department debt where it's used to invest in something that is also generating an asset stream. So let's get rid of that. Once you start eliminating these things and getting down to the real debt, yeah, there's debt. There's debt. But there's also income associated with a lot of that debt. So no, well, you could say, well, payments will be $2 trillion. Okay, what will the interest income be? They're just focusing on the interest expense. What will the interest income be? Net it out. They're not netting it out. Wall Street Journal. I mean, would they ever look at a company and say their interest expense is going to be, look at the bank, its interest expense is going to be this. Yeah, but it has a whole bunch of floating rate loans, so its interest income will be this. You look at the net interest margin, the net interest income of the bank, not just one side of the balance sheet. You look at both sides. You look at liabilities and assets. They're only looking at the liabilities, and they're looking at 100% of the liabilities without netting them out. So a good example is companies that have debt right now, investment-grade companies that have debt and are, let's say it's floating rate, and are paying 5.5%. And they have $10 billion, but $9 billion in cash, and cash equivalents that's earning a money market rate of 5.5%. They really only have $1 billion in debt. If you think they don't have $10 billion in debt, they got $1 billion in debt. So if we look at how much corporate debt is outstanding, you then have to say, okay, great, how much cash is on all the balance sheets? Because that cash could pay that debt right here and now. And net those out, and that's the net debt. If you have an upward sloping yield curve, then you can make the argument that that's a bad thing because you're getting this on your cash, but you're paying this on your debt. But we have this right now, which means you're getting this on your cash and you're paying this on your debt. Do it all day long, right? So, half a story. Half a story. Have you looked at countries in Southeast Asia for moving? I have. Singapore, looked at Singapore. Not that easy to get to Singapore. I'm from a region myself and think that Vietnam or Thailand would be great. Tropical region, low cost of living, close to beaches, and rather safe. I think my mind is made up about the places that I'll be looking at over September and the choices that I'll have. But I think any choice I make is a 2 to 3 year choice, and then it'll be time to move to another country. I want to see the world. I want to experience the world from a different set of eyes other than just, Canadian eyes. Because you see the world in a particular way. And there's only one life, right? What is the reason that prompted you to move out of Canada? Mainly the tax benefits. Well, I don't have tax benefits. I'll tell you that. I got tax disadvantages. The more successful you are in this country, the more you will be punished. They like to word it as you have a greater responsibility. But it's not responsibility any longer. It's punishment. It is simply just punishment. So I have a 53.5% tax rate. right? So I have my income, and then I want to spend money. So what they say is, you're very successful. How dare you? 53.5% belongs to us. So I have a partner in all of my businesses. I'm a minority partner in my own business. The society owns 53.5% of everything, and they do not make any kind of investment in my business at all. So 53.5% they take away from me. And then I can go and spend it, and I have to pay a 13% consumption tax. However, if I want to buy something that they call a luxury item, well, you're really successful. Here's another 20% sales tax on top of that. Get me over here, and then let me spend money. Or if you want to tax successful people, get me over here, but don't get me over here. But you're getting me over here, and you're getting me over here. And we have two prime ministers in Canada because we have a coalition government. Prime Minister Singh says, well, that's not enough. We want to come back next year and take another 2% of whatever you have left over here. And then when you spend it, we still want the 13%. And if you want to buy something that other people can't afford, how dare you? We want another 20% of that price. And we're going to come back and take 2% every single year. This is slowly becoming an animal farm. And I am not going to be a horse on this animal farm. Our tax system is no longer fair. It is completely unfair. And the reason it's going to get more unfair is you got to pay these bills. And the top income earners are not a large enough segment of the population to change any election. So it's easy to demonize us. It's easy to call us names. It's easy to call us tax cheats. It's easy to say we don't pay our fair share. It's easy to tell the people at the bottom that it's not your fault. It's these people up here. It's these people that aren't paying their fair share, that aren't carrying their weight, that aren't paying their bills. Let me tell you something. In my income category, we don't see cash. We leave footprints everywhere we go because the numbers we deal with are just simply too big. We don't have a cash register and a storefront where people walk in and we can make a cash deal. Everything happens online. Everything goes through bank accounts. Everything leaves a footprint. We would have to blatantly lie. We would have to break the law, blatantly lie, and hope we don't get caught. Biggest tax cheats in any economy, in order. Hairdressers, number one. Number two, farmers. I'm not sure if I got these two right, but farmers. And number three, hospitality. Hospitality. So waiters, bartenders, hairdressers. I just switched hairdressers, and the new one I'm at does not take cash. The one I had in Windsor does not take debit, cash only. One I had in Windsor, cash only. There's no cash register. There's a drawer that opens up and the money goes in the drawer and it closes. Farmers, every time you go to one of those roadside stands and you buy something, a basket of peaches for $10, you hand them $10, that's cash. Their inventory literally grows on trees. The biggest tax cheats in an economy are here, not in the top 10% here. So here is something ironic. If you went into a restaurant where the top 1% of society ate, you would find the biggest tax cheats. But they would not be the patrons, they'd be the servers. Yet somehow, for creating employment, for bringing money into the country, I am singled out for solitary punishment, and people like me are singled out for punishment. I have no problem with a 40% tax rate, but this is confiscation. That's a 13.5% confiscation rate. Sales tax, fine. This is just a big fat money grab. That's another confiscation rate. And to come back and confiscate another 2% of my wealth, this is an animal farm, and I will not be a horse on this animal farm. That's a big reason, is fairness. It's just unfair at this point in time. If the Conservative Party in Canada cannot get a majority, you're going to have another socialist coalition government. And we are, from year to year, becoming more and more concerned about problems that simply have no solution, attempting to solve the solution by making people who are successful pay for it. And it's, capital flight is a problem with a tax system. There is something called the Laffer curve, where this is your tax revenue, right? And this is your tax rate. And as you increase your tax rate, you'll increase your tax revenue up to a point, and then it starts to decrease because you'll have capital flight. You'll have money that just says, I'm out of here. I mean, California is seeing that. It had, 25,000 people leave last year? And these aren't the homeless. The homeless aren't leaving California. The homeless are entering California. And those who are at the 50 and 55% tax rate in California are saying, okay, this is ridiculous. I'm out of here. And they're leaving, heading to Texas. Can you suggest some books that can help me understand valuation of REITs? Yeah, last name Block. He died. But his book, I think, was the best. So if you type in Understanding REITs, author Block, B-L-O-C-K, you should find it on Amazon. With PMI under 50 in the U.S., lower production and exports in China, don't you think copper price should come down even more? Not when you have low inventories. And if you look at the inventory levels at the exchanges, at the LME and Shanghai Exchange, they are super, super low. Much like the inventory of houses for sale in the U.S. are super, super low. So with high interest rates, we should see lower prices, and we don't. And that's what low supply will do. Where and how do you purchase 25-year bonds? I did show how to do that. Use the Treasury feature, click on bonds, and the window below it says maturity date, find 2048, and it'll give you the list of bonds maturing in 2048. Any updates on level 2? You said some news upcoming May 2024. Today is August 15th. So registration for level 2 for 2024 open today? Is that what you mean? I don't know. I don't know what news I had. What do you consider the good and bad points of living in Canada? The good points, if you're living close to the border, the good points are that I think you have, I would consider a safer environment to live in than the U.S. I think a more tolerant environment than the U.S., at least some of the northern cities in the U.S. That I've been in and that I've lived in. I don't know that there is, if I woke up again in Cleveland, in Westlake, or I woke up here in Fonthill, I don't know that I would see much of a difference. I don't know that I would see, for the most part, much of a difference overall. The big difference is healthcare. It's more expensive in the U.S., but you get it. If you want an MRI, you can get one next week. I, as a Canadian, can call a clinic in Buffalo, and they'll schedule me in next week. And I don't need a doctor to refer me. I don't need to go to a specialist first. Not in a socialized healthcare system. That doesn't happen. You have to go to your doctor and make the case that you need one. The doctor then sends you to a specialist who will then and then you got to make the case that you need one. Then you got to book an MRI at a hospital, and that's going to be a bit of a wait as well. 18 months later, you get your scan, and the doctor says, if only we caught this 12 months ago. Here's the name of a good hospice location. You die. That is socialized healthcare. Everybody gets the same health care. And the only way everybody gets the same thing is if everybody gets the same equally poor care. And that's what you get in Canada. People who have money don't stay in Canada. They go to the U.S. So there's already a private healthcare system in Canada. It's called the U.S. We already have it. The fact that Canada will not allow a private healthcare system along with a public healthcare system, to me, seems to be the biggest, dumbest lefty thing that you can do. Oh no, it would be unfair to those who can't afford the private systems. Like, we already have a private system, people. It's called the U.S. I'd be there in a heartbeat if there was anything significantly wrong with me. In a heartbeat, I would not leave myself to the Canadian socialist healthcare system. Not one bit. Not one bit. Period. I'd say that's sort of the bad thing about living in Canada is the healthcare. You wait. But it is a general lack of guns in all of Canada where I've lived, in all of the cities I've lived in. I cannot recall ever hearing gunfire. When I lived in Cleveland, every night. I lived in East Cleveland, mind you, because that's where the university was. First 2 years I lived there. Every night. If you didn't hear gunfire, you just weren't listening, or you just weren't paying attention, or you willfully didn't want to hear it. But it was every single night. I don't miss that. I believe that the raise of the long end of the curve indicates that the market is pricing in sustained large deficits, ultimately high T-bond issuance, instead of showing an opinion on whether higher GDP inflation is to come. Well, the levels are going up, but it's not flattening. Yeah, that is basically what it's doing. At this point, it's looking at events and not trends. And listen, the moment money needs a place to hide, none of this is going to matter. There is no other place to go. If money needs safety, there is no other place big enough to handle those kind of flows. There's no other place to go. I'm moving to Costa Rica. Do you think that I'm going to put any of my money in Costa Rican government bonds? They default on average about every 18 years. Do you think I'm going to put a single penny into their bonds? No way. If you need to put money somewhere, it's going to be U.S. Treasuries. It's the easiest thing to get into. It's the easiest thing to get out of. So, yeah, you can, clutch your pearls and say, oh my God. But listen, if you're terrified of the U.S. government, what about everything else? Think about that. If the U.S., if you're saying, oh my God, that U.S. Treasuries, we can't go anywhere near the risk of U.S. Treasuries, what are you saying about everything else? If the safe haven is on fire, where are you going to go, right? So it is everyone doing a little bit of pearl clutching right now, but when push comes to shove, they're going right back home. So I am unconcerned about this. Bid to cover ratio speaks more about the number of bids placed at an auction rather than the price of those bids. That is true. It does. Perhaps investors are indeed showing interest in T-bonds, but only at higher yields. Well, that was the outcome of the 30-year. It was at higher yields. When you talk about option strategies, are going long or short the corresponding ETF since indices don't issue securities. Hang on. When you talk about option strategies or going long the corresponding ETF, since indices don't issue securities, right? I don't know if that's a question that conforms to an English structure I understand. I don't know how to answer that because it doesn't seem like a question to me. How important would you say is going to the gym or sports in general, additional learning and educating yourself? It depends on who you are. For me, I feel it's important. It makes me feel good. I think healthy body, healthy mind. Maybe it's not your thing, and if it's not, then don't worry about it. It has to be something that you would enjoy. But I think if you went to a gym and you got yourself a good workout program by one of the trainers there, you don't need a personal trainer every day you go in there. But get one of the trainers to design a workout program for you. When you first start, you might have a 2-day program, and then you'll eventually move that to a 4-day or a 5-day. And then just start. The the gains, when they start happening and you feel yourself getting stronger and you see your muscle getting more defined and getting a little bit bigger, you start to gain more confidence. It does have a lot of biochemical advantages as well in terms of what goes on in your brain when you exercise. So to me, it's important. Are junk bonds worth it for the issuing company? Well, yeah, I think it's worth it. It's if it wasn't, there wouldn't be a market for it. If they are considered very risky bonds, that means the perceived credit risk is high because the issuing company is seen as risky. So wouldn't a default put a company at risk of a bankruptcy? Well, not at risk of a bankruptcy. That basically is what happens. Hurt the providers of capital? Yeah, well, that's basically what happens. Yep, that's it. That's exactly what happens. Long story short, is the benefit of raising capital with high-risk bonds worth the risk? Yeah. Yeah, it happens all the time. There is a big market in high-yield bonds, so it must be worth the risk. I hold high-yield bonds in my portfolio somewhere in my external managed money. I know I have high-yield bonds somewhere. I own companies that have high-yield bonds. Freeport, his bonds are rated by 3 companies. 2 of them rate Freeport's bonds at the lowest investment grade rating, and 1 at the highest high-yield rating. And their net debt is more than manageable and payable with their cash flow. It doesn't make them risky. I have no problem with that. When using a discount cash flow model to value an asset, one estimates the cost of capital using weighted average cost of capital, internal rate of return as the expected return. But what is used to compare the actual return with the internal rate of return? Well, your weighted average cost of capital is the required return. That is the cost of your capital. So you'd compare the IRR with the cost of capital. Discount cash flow models use cash flows, so that renders the ROE useless in that regard, since it measures the net income generated by equity and not the free cash flow to equity. I don't know if I'd say return on equity is useless. I wouldn't say that. So what is used to assess the actual return on the capital project against what was modeled? Present value. The present value of the future cash flows. If it's net present value positive, it's value enhancing, because the cash flows are discounted at the weighted average cost of capital, and your initial cash outflows are your capex. So if it's net present value positive, the cash flows more than cover the initial capex. Also, doesn't that make ROE useless as a measure of return? No, it does not. Nope. The video and the video previous week do not show the sections. Have you watched Jon Stewart's interview with Larry Summers? No, I don't watch Jon Stewart. Since the Daily Show ended, I don't bother with him. Keep in mind, he has an audience, and his audience is more left, so he delivers to them what they want to hear and what they want to see. He does interviews and then highly edits those interviews so that he always comes out looking like he got the better part of the other person. So he's in charge of the editing, and he has an audience that's left-leaning, and he's trying to appeal to that audience. He's lying to people who want to be lied to. So if he asks some questions and he got embarrassed by the answers, if he got put in his place, you'll never see it. He's in charge of the editing. He's not going to let you see that. He's going to see an interview where he's absolutely right, and he asked these questions where these really smart people were suddenly deer in the headlights and couldn't answer a question from a guy who has no economic or financial training whatsoever. Come on. They're highly edited for consumption for his audience. They're not real. It's produced content for his audience. He is no different than Fox News. He's no different than Tucker Carlson, except he's the Tucker Carlson for the left, and he manipulates his output so that it looks like he won. That oh my God, look how easy it was to push these people around. Come on. I mean, he talks about things sometimes. I've watched a few things. He has a show on Apple. I watched a couple episodes. Okay, you don't even know what you're talking about right now. Like, you don't even know what you're talking about. So I stopped watching because I thought, well, he's not talking to me. He's talking to people who want to be lied to on the left. He's the Tucker Carlson of the left. You know, that's what he is. He's just as responsible for the level of misinformation out there as Tucker Carlson was responsible for the level of misinformation. He is Fox News, except for the left. So no, I don't think I would waste my time watching anything by Jon Stewart. Why is there so much coverage on the dates of dividend announcements and payments? Well, because it's a press release that's issued by the companies, and news feeds usually pick up press releases and just relay them. It's not like an author is sitting somewhere saying, oh my God, here's another one. It just hits the newswire. So a company that issues a press release is a press release for immediate release, and it's issued to all the media outlets, and a lot of times that's just automatically sent to their news feed, and that's how it gets out there. Wouldn't a data-driven Fed cut rates once the pendulum swings to unemployment? Higher for longer seems as unrealistic as those who thought oil would stay at zero in 2020. Oil is going to respond to a market. Interest rates are engineered. Bond yields will respond to the market, but interest rates are engineered. So, it's a matter of what we think the Fed is going to do, and unless they have a compelling reason to lower rates, I don't think they will. What took you so long to move out of Canada? Comfort. When you're in your comfort zone, you can take you can handle a lot of things that otherwise you'd say is negative, and if you're in your comfort zone, you can sort of absorb it. It's kind of like, why do people stay in bad relationships for too long? Comfort, fear of the unknown, fear of leaving. So there we go. We are done.